Well, we roll into the second half of 2023, but does anything change? Do AI thematic stocks and mega-cap tech continue to find a bid? Do we hold the range in the US dollar while carry continues to be the play of the jour in FX markets? We've got bond yields moving higher, and does that eventually destabilise the risk trade coming through? And we've got a potential breakout on our hands in Bitcoin as well, something we're going to be focused on in the trade-off. Well, hi there, my name's Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined by the returning Blake Morrow. We've had Quasar, the Latin Prince, stepping in for a couple of weeks, done a fantastic job, but we bring Mr. Blake Morrow back into the programme. Mr. Blake Morrow from Forex Analytics, how are you going? How's your holiday, sir?
Yo, I'll tell you what I want, what I really, really want. So you tell me what you want, what you really, really want. I'll tell you what I want, what I... Wait a second. I thought you said this was the Spice Girls tour, reunion tour that no one wanted, and that's what today was.
No, I felt like it. It was kind of like one of those things, isn't it, where I felt like, you know, with the old timers getting back together, you know, well past their sell-by date. But the people want it. The people want you, Blake.
No, they want you. And you know what? It's great to be back with you, Chris. I had a lot of fun with Quasar while you were out and about frolicking at your mate's wedding. But it's nice to have you back, and I'm back too for the remainder of the summer. So
well, mate, I was coming back from
back here.
I was coming back from the UK, the week before, and of course I caught a man cold from the plane, and I hid it really well. I mean, obviously there's very little that's worse in life than a man cold, and I think I did a pretty good job in disguising how just on death's door I was last week. But bouncing back, feeling good, fresh for the fight, and keen to debate these world of markets with you, Blake. See how you think of this after a couple of weeks being apart from each other. God, I've missed you. And now we're back on with Topical Fund, and let's kick it. All right, let's go to sentiment. I talked about this last week, but I think it's a great place to start. If I look at the S&P, we've not had a 1% down day, I think, in 28 sessions. It's the most since November 2021. The VIX is trading at 14%. We're seeing skew on optionality being reduced. So people have been rolling off the hedges. The put-call ratio on the SIBO is at 0.52, so one of the lowest levels we've seen for a while. FX vols are shot through the floor at the moment, which is why carry continues to be a pretty good trade. Everyone's piling into that. And the dollar's trading a bit sideways at the moment, which I think is allowing vols to continue lower. But one thing we are going to talk about very much is this unrelentless sell-off we're seeing in the bond market, both on a nominal and a real basis. And does that now start to derail risk? I will say this, Blake. July is the month to be long the NASDAQ. I think every month for the last 15 years, the NASDAQ has rallied, and I think on the average of those 15 years, it's about 4.6% gain. So the form book suggests we go higher. This time could be different. The backdrop is different. How are you reading the markets here? Are you feeling strong, positive, or do you think we've got a bit of downside risk in risk assets?
You know, it's funny. You talk about sentiment, and 2 weeks ago when I was on with Quasar, we talked about the S&P, kind of rejecting the 161% extension. Felt that the markets were a little overbought and sentiment was a little too one-sided. I think Quasar felt the same way. We corrected a little bit, but we bounced right back, and we're right back at those levels. And I can't dismiss this insatiable, buying sentiment that we're getting. However, to fade it is a risk. I got run over.
It's been hurt. Hurts. Shorting the NASDAQ's hurt, right?
And I haven't been short on the NASDAQ. I've been like long yen, and that trade didn't work out. I got stopped out fairly quickly. But the thing is the market is too overbought to be bought, but it's too strong to be shorted. So it's kind of like, I don't know really what to do. I think we're going to get some clues later this week, which we'll talk about in the next subject. But sentiment is, everybody's FOMOing it. Is that what you call it, Chris? FOMO?
There certainly was a bit of FOMO going into the back end of the fiscal financial year. And, I think you make a really good point there, is that can we chase it? Can we chase risk equities and things at these levels? And again, that feels hard to do. But yeah, if we get a breakout in the Nasdaq, then I think you've got to, and I think you've got to continue. But yeah, like the best time to be short these markets is when the bid dries up and volatility picks up a little bit, and you can see the rate of change pick up, and that's just not happening at the moment. So you've got to take those time frames in and work the tape, but it's a tough one to be doing either at the moment. So we're waiting for the market. This is where patience in trading comes in, right? And patience.
Yeah, go ahead. I'm sorry. Go ahead.
No, I was just going to say patience. Wait for the market dynamics to change and then start the trade. If you're forcing the trade in these conditions just because you want to trade, I think that's generally why retail traders blow up. So yeah, patience is key, I think.
And that's the exact same commentary I made to the Forex Analytics clients earlier today, is that you have to be patient. But look, we might only be a day or maybe two going into the next subject, producer. We might only be a couple of days away from that sentiment shift. And that's where I wanted to bring up this topic, Chris, of talking about non-farm payroll. We have almost consistently beat the numbers. And look, the market has responded favorably. We've been rallying as the numbers have been good. Are we at a point, and I asked my colleagues at Forex Analytics today this exact same question. I wanted to bring it to you because I think it's an important one. How is the market going to respond to this data? And I got a couple of different responses, which I thought were great responses, but we get, let's just say the jobs report continues to be strong. And we're like, oh my gosh, well, I guess this isn't the month where labor starts to, look a little more dim. Maybe the payrolls numbers are great. Are markets gonna respond positively again, knowing that the Fed is at, you could call it a neutral rate, really close to the terminal rate, whatever you think it is?
Yeah.
The Fed could continue to raise rates. However, the market has been cheering a stronger economy, or maybe that we might skirt a recession. Flip side is, if we get bad data, do the markets actually pull back a little bit? And I know we might go a little long here, but do the markets pull back because, the jobs market is starting to weaken and this is what we were waiting for before a recession starts? Or maybe they'll feel that the Fed needs to continue to not push rates higher. Maybe they'll keep rates steady or maybe even cut them in months ahead. But what are your thoughts here with the NFP?
I think you make a point. I mean, we've beaten 14 months in a row now that the actual jobs print has come out above expectations, and I think the 12-month average is 336,000 jobs. So one suspects, the form guide says, we get a strong level of job creation. Now, 2 months ago, I would have said to you that a high level of job creation could be a negative for markets because we want to see a cooling of the labour market. I don't think that's true anymore. I think the market wants to see a strong jobs level of creation, and for those points that the economy is humming along. We're pushing that recession trade back, and as long as that continues to be the case, I think equity markets find a bid. The most important element, though, is that average hourly earnings. That's the most important. Any inflationary read you're seeing in the market, as long as that suggests that core PCE is going to go down to the Fed's target or estimate for the end of the year at 3.9%, I think there's downside risk to that. Anything that suggests that's the case is good for risk. Now, so I think the Goldilocks scenario is we get a number north of 250,000, but the average hourly earnings needs to come out below 4.2% or below. If that's the case, we'll cheer a strong level of job because wages are going down, they're stagnant, and core PEC is going down to target. So I think it's a pretty simple one. I think the market will tolerate jobs anything above 180,000 as long as the average hourly earnings is weak, and I think that's the Goldilocks. So again, the question then is if what happens with 2s, 5s, 10-year government bonds. If yields go up, are we going to start seeing that dynamic where bond yields have been moving up and equities have been moving up in correlation? Does that dynamic start to break down now? Do bond yields actually start to say, well, these are long duration assets, the discount mechanism that we measure these cash flows by is actually starting to bring down the present value of these companies and actually starts to weigh. That's the thing we're going to see at the moment. Higher bond yields are rallying with equities.
And so let's flip it to the next topic and let's talk about yields, because you bring up a great point. And by the way, my colleague Ryan Littlestone, who's on the other trade-off, the
big up Ryan,
the inferior, he Joking, guys.
We're
joking.
better than them.
Anyway, he also mentioned the same thing that you did. He's along those same lines in your thought process, which is great. But let's talk about yields, because yields have been ripping, and it's not just U.S. I mean, everybody looks at the U.S. 10-year and they're like, "Oh, look at the U.S. 10-year, it's ripping." But it doesn't matter if you're looking at Boons, Shants, whatever, gilts, whatever you're looking at. Bond yields are ripping, minus Japan, right? I guess they're really not going anywhere.
39 basis points on 10-year JGBs at the moment. Change the yield curve control. Do it. Get some vol in the market.
I mean, but yields continue to rally. And this is where I start to add, I've asked you in the past, back when yields were ripping, months ago, and we had the same conversation. And I want to have that same conversation again today, 6 months later, when bond yields are ripping again and stocks are getting to that little peaky point. Where does it start to not make sense to own equities from a risk reward basis if you've got yields of securities that are riskless in your mind, that you could be yielding a very decent percentage on some longer term duration securities? When does that risk outweigh the reward when you're buying equities? I mean, what do you make of this bond market yield move, and where does it really start to bite equities that you were just talking about a couple of
It's an interesting one. I mean, we would always look at the equity risk premium, so looking at the earnings yield relative to the risk-free rate, and that's at the lowest level since 2002. So, I mean, anyone who's sort of classically, theoretically trained in equities and, looking at things like equity risk premium, that there is very little there. And that usually suggests that you're not getting paid for the risk that you're taking on in equities at the moment. I think in the front end of the curve twos, I wouldn't be doing, too much in terms of selling there. I wouldn't necessarily want to be buying, because I think the market's obviously looking at a July rate hike playing through, and then they're sort of weighing up, do we get another rate hike in September? No, maybe sort of November. There's a 50-50 chance of that. And so twos, I think, are fairly well valued at the current levels, around 4%. It's the back end of the curve, the tens, which I think is getting all the function over the last 24 hours with the breakouts we've been seeing there. Can we push up into what I think we got in March, got up to about 4.08%? Can we push up into those levels? But I think a four handle on the tens could psychologically be good for money managers. They may start looking at getting in there. The one you want to look at there, Blake, is the 5-year real rate, or TIPS. That's broken out now. And that's the real cost of capital that people will use there. So that to me is something that real rates are moving up. That's a proper tightening of financial conditions. I can't see how the Nasdaq continue to push up much higher from these levels, with real rates moving up, and the rate of change is picking up a little bit as well. So I think that's good for the US dollar, and I can switch over there. But have you got a quick thought on that one as well on yields?
Just I'm kind of in the same line as you. Is yields, as they continue to move higher, how does it start to affect the dollar? And I think that we're going to go into your next topic, which will be the dollar, right?
Yeah, I think the other one is the yield curve as well. I mean, we've seen 210s, the yield curve going from around negative 110 basis points. We're at negative 101 at the moment, and steepeners are. Everyone's been trying to do steepeners for a long time and getting absolutely carted out. And that's your recession indicator. So, when we get a deep inverted yield curve, so that's a sign of a recession. It's actually when the curve starts to really steepen, that's when we know it's on. But it's when the front end drops significantly that's you're working. We're not there at the moment, but something we are watching is that inverted yield curve. And when you bring up the dollar, so if you look at the dollar index, I don't have a chart unfortunately, but the dollar index has sort of been trading in a 106, 101 range for quite some time. But now we're starting to see US yields moving up, and they're moving up relative to other countries as well. So that spread widening is potentially a dollar positive. It's all being carried this year, isn't it? I mean, everyone's long dollar yen, or just using the yen as a funding currency. The CNH, the offshore yuan, has been another funding currency. And in EM, everyone's long Mexican pesos and Brazilian reals. The dollar's moving sideways against a lot of the G10 countries, ex-Japan. But there's some big trades that the macro hedge fund communities have been on this year. And as I say, short dollar Mex, short dollar Brazil, long dollar yen. And those trades have done very well, but everything else is sort of trading in a range. So how are you seeing the US dollar now? And is there any particular trades that you really like here?
Well, there are, and that means you're going to have to stick around for some of our setups that are coming up in just a few minutes. And I don't want to give them all away, but because I'm going to be pretty FX centric through the setups. But I do want to say that the dollar, it is consolidating. You're right; it's consolidating below the 200-day moving average. It's trading below or around the 106 to 101 range. It's tightening in a triangle, which is a tightening. Usually a continuation type of pattern when you look at it, and considering the fact that we are consolidating a sell-off that happened in 2022, like the second half of 2022, we're just consolidating near our lows. Theoretically, we should be resuming our downtrend. That means the euro should be trading eventually back above 111 if you go by like technical playbooks. But there's a lot more at work in the markets than just technicals. We have a big macro backdrop. We have, a lot of shifts in monetary policy and expectations, inflation expectations, yada, yada, yada. So where rates go from here with the Fed and what inflation does, there's two sides to that argument, two distinct sides, whether we're going to see sticky inflation or more of deflationary, not disinflationary, going into like deflationary pressures. So there are definitely two camps. And so you can see where the standstill is. I think the dollar looks great against certain currencies. But then again, as you pointed out, I think it looks bearish against others. So, where I stand is kind of in the middle at the moment, like the charts.
Quick one, dollar yen.
Yeah.
Can you be long dollar yen knowing you've got that intervention potentially going? I mean, if you're sitting on a healthy position, you've been riding this as a trend, you're happy to do it. But yeah, if we were to get the Ministry of Finance coming out and intervening, causing a 500 pip rip to the downside, it's hard to be long dollar yen for me at these levels. I mean, if you look at the daily chart and dollar yen at 145, the momentum trader in me suggests buy the breakout and just hope it rides. But you've got this monkey on your back, haven't you, that says, any stage that, because the trade weighted yen is lower than where we were September last year, that they could come out. I mean, the first point of call is that they check the markets. But then you're sitting on, especially when you're using leverage, you're down 500 pips. You've probably been stopped out and got slippage because it's been such a fast rip.
Right.
The yen's a hard one to be long, to be short right now, right?
It is, and I've tried to be long yen a couple of different times, and I've managed to milk it a couple of times. Last week before I took off on holiday, I got stopped out on a dollar yen trade, and I was a week too early, which is it happens. But I will say this though. I don't know his name. Anyway, one of the guys from the BOJ who's throwing out the warnings right now, that 145 level looks, what's his name?
Kanda's the chief currency guy, and he's been talking, he's been open. He's the most important person in the Bank of Japan, or within the Japanese authorities. Yeah, when he's talking and saying he doesn't like the one-sided moves, we're on notice now. The next play is when you see headlines saying that the Bank of Japan and the Ministry of Finance are checking rates. That means it's on. We're properly on intervention watch, and it's a matter of time before they come out and do it. So we haven't got to that point yet, but when we see those headlines, I'll certainly be looking at those charts and keeping my eyes on the yen very closely. I think we're going to have to wrap it up.
I was going to say, I know we got to move along, but what a strong jobs report might do that.
100%. If we get especially imagine you got average hourly earnings above 4.4%. That would surprise. It's not being predicted, but if it would surprise, it's not out of the realms of possibility. 4.4%. We get a big payrolls number. You got dollar yen through 145. We are on weekend, Monday morning intervention watch straight away. So put it on your radar and do consider your position sizes and your leverage, especially in that environment there as well. Anyway, let's go to that's a setup. I'm going to bring up the NAS. Love it. Love the chart. Love the chart. So let's bring it up. Okay, because what we've got is the weekly here. Yeah, obviously we just used the weekly for oversight here, but you can see all the way really through. We broke out the channel in February. We sort of pushed up, and you can see I've just marked on those green arrows. Really, just showing all the way through that point is that when we got the pullbacks, really big buying support coming through, and you can see reasonably long wicks, and you can just see the market absorbing that. And where we've got to now is you've got to a point. Last week we saw a bullish outside week reversal. And I was suggesting to clients that we do buy stop orders above that orange line, because you've got a higher high coming from the bullish outside week. But you've also got to push through that obviously the very clear resistance levels that we've got there. So I'd just be looking to wait for the breakout, let the market show you that they're ready to continue pushing this one higher, because we've got balance sheet reduction coming through. I know that the reserves haven't actually been drawn down as much as RRP, which is net positive, I guess, for risk, but we are significantly overbought at the moment. We're coming into earnings season in the US. I know that the big tech companies don't report to the end of July, and you can see momentum in the rate of 3-day rate of change on the bottom there coming down. It's a tough one to do. I feel it in my gut, in my bones. We've probably got some downside risks, but the technicals aren't there. We talked about it earlier. How are we trading this one, Blake?
Well, we are right up against that big resistance that you have drawn out, and about 250 points higher than this. So think about like price action following. We do have like ISM, weekly unemployment claims. I think some other jobs data like JOLTS, I think tomorrow. Anyway, but really Friday's jobs report. Think about what happens after that. So just about 250 points higher at 15,450 roughly is the 78% retracement of that entire move, that entire chart that you see there, Chris. So what I'm thinking is we might have one last gasp higher in the NASDAQ, maybe to test that resistance. So it still looks strong.
Yeah, if it does. I mean, I just wonder how. We talked about the balance sheet being the Fed's balance sheet drawdown being and liquidity being the red flag, but it hasn't been so far. And as I say, bank reserves haven't been used to fund the Treasury bill issuance. It's mostly been RRP at the moment, which is already been it's money out there. Bond yields are probably now the big thing. If real rates continue push up, do duration assets? The pain trade's still high, to be honest, in my opinion. I think it's higher. So I'd be waiting to get the breakout and then looking to try and ride potential trend. So we'll see what happens there.
Very good. Well, the chart I want to bring up is the setup of the Euro Canadian. This is called this is basically a bullish wedge when you have consistent highs and higher lows. That means it's building for, like pressure for more than likely higher percentage breakout to the upside. Notice how this entire move, when you take the low of, back in August of last year to the highs of this year, we were just about getting to the 38% retracement. Really shallow retracement. 200-day moving average is supportive right below that as well. So if we break out above this 145.20, 145.30 level, that should allow for an upside breakout. And by the time we get there, we'd break above the 50-day moving average. And so that would just further accentuate the move higher for a resumption of trend higher. And I'm actually pretty bearish Canadian dollars right now based on what the US dollar Canadian is doing on a weekly basis. So anyway, EURCAD, bullish wedge, a lot of support down below. We know where we're wrong. What are your thoughts here, Chris?
Yeah, I love the setup. Again, this is one that needs a bit of work, and let the market come to you. So patience is your virtue there. I think when it reveals itself, I think it could be quite telling. So there's obviously, just a battle going on between the bulls and the bears. No one really wants to stamp their authority. And of course, that's what these wedges pattern do. Ranges are narrowing out. And when someone, decides that they want to be the dominant party, and what you want to see, obviously, in these wedges is when it does break out, you want to see a big range expansion on the breakout. You want the market to close that bar on its highs or its lows. And that tells you just how dominant that breakout is and how much of an authority that party wants to be. So for me, again, this is a great setup. Just monitor it and when the setup's complete, you obviously want to see the quality of that completed setup, and then obviously try and trade that. Of course, with any setup, they don't always work, and a lot of them do fail. So you need to make sure that you cut that position pretty quickly. But
Absolutely.
It's a great setup, and I'll be watching this one very closely. I mean, I can talk to the fundamentals on this one, but right now the market's having a battle, and I think someone's going to win this pretty soon and make their case clear. And we'll probably want to trade that as well. Another one which we are seeing a bit of a battle in is Bitcoin. Now I want to bring this up because Obviously, there's a lot of news going through at the moment in terms of Bitcoin. Larry Fink, look at that headline. What an absolute
That is the best headline I think you've put together ever.
So obviously, Larry Fink has now become the poster child of crypto, and everyone's sort of saying, although the crypto maxis, I think they call them, are up in arms and saying, look, we're against the big money centers. We don't want to be there. Now they're obviously peddling their wares there and pushing this one. But from a price action perspective, I've got the weekly chart again. We've been trading a bit of a range. You can see that sort of dotted line. We've broken out of that range with power, and we're pushing the range highs at the moment around 31,000. Now, obviously, we're waiting to get the SEC's verdict on whether or not the Bitcoin ETF that invests obviously in the spot market, first one, opens the floodgates to a new avenue of investment, and obviously potentially even changes the PR. Obviously, does Coinbase coming in as a surveillance change that situation for the SEC? We'll have to see. And if anyone's going to get an ETF away, it's BlackRock. They have so much success in doing that, and they'll persevere here. But it will open the floodgates. So it's a big there's a big battle between the crypto heads actually whether this ETF is a good thing or a bad thing. Most of them think it's a bad thing. But for me as a trader, if this breaks, does it start the trend into 40,000? Is this going to start bull trending? I think it will, but I don't know. I'm not going to trade it until we get that breakout. And as it starts moving up, then of course, a trend turns into FOMO chasers, and that's something we're watching as well. So, what's your thoughts here, Blake? I know you've got some pretty strong ones.
Well, just a couple of weeks ago, and I believe you were not here, Chris. We looked at the Bitcoin 25,000 level, how big it was. We must have mentioned over the last, how long we've been doing this show for the last year plus. We've talked about that 25,000 level multiple times on Bitcoin. We came down there, tested it, broke slightly below it, and then ripped higher. And every one of those black rocks that are out there, the wisdom trees, the ones that are putting together these ETFs, they have technical traders that they talk to that are on their desks, and they're like, what's the big level that we need to watch? You start accumulating at the 25,000 level, big news comes out after it's already moved to 29,000. And then you make the announcement that you're going to have an ETF. These guys made a quick 20% quicker than you could say, holy oh my God. And then now that they expect us to just think that it's all going to work out. So I don't know, Chris, I'm not one for chasing, but there's going to be some big money coming behind this on a breakout. I do believe that. But man, what a job did they put on the market? They caught everybody.
Yeah, they did, mate.
They're good.
Anyway, definitely wanted to put on the radar there. I think if we get the breakout, I think obviously this could start to trend, and that's something that we're going to be watching. I think that there's certainly the news flow around this has picked up. You've seen that in the Google Analytics and various things. So, one to watch.
It has. All right. Well, let's flip it over to my last setup. And like I said, I didn't want to give away all my dollar shenanigans, what I'm thinking here, but I do want to give a shout out to you, Chris. You put together a wonderful interest rate video post RBA. So I think that if any one of our viewers that has not seen that video, they need to go back and watch that. How many days ago did you do that? 2-3 days ago?
Yesterday.
Was it? It felt like a week to me, but yeah, okay, you did it yesterday.
I've aged you, mate.
Anyway,
I've aged you.
Hey, I was one of your viewers, so I gave you a thumbs up, as everybody should here right now. Yeah, just reach down and hit the little. There you go.
Check it out. Anyway, check it out. Check out the video.
Smash that like button, as Chris would say. Anyway, look, we have a bear flag developing, and the reason why I bring this chart up, Chris, is because post RBA, the Aussie dollar rallied right into the 38% retracement at 67.15. We're starting to break through flag support. I don't want to get too carried away while it's above 66 cents, but I wanted to show you the possible target. Now you'll see that black line that is all the way down at the bottom of the chart. That goes from, let me just get my dates correct, because I have to go out to a weekly chart. That is connecting the lows from, one second, the lows from March of 2020, post-COVID lockdown lows, all the way to that level, which comes in right around 64 cents, say roughly. So if the flag did complete, it would complete right to that long-term trend line. I'd turn around and get long. But anyway, if that happened. I just want to say it is waving its bear flag and everybody should be paying attention.
Yeah.
What are your thoughts on the Aussie? Because I know you have a lot.
Well, I love that pattern. I mean, there was a chart you brought up a while back, which was a bear flag. I can't remember the exact FX pair, but it worked out an absolute dream. So once this completes, if it does complete to the downside, I think, it's just it's a high probability setup. And I think the RBA raised rates in the 1st of August meeting. I think it's probably priced around 16 basis points or so now. We've got jobs numbers coming up on the 20th, and then the big ones, the employment number, the CPI number on the 26th of July. But yeah, obviously we're watching what happens with Chinese equities, Hong Kong equities. I think, if the Hang Seng was to fall a bit further, we saw copper prices and iron ore start to drop a bit more. Big if, of course, then this flag pattern completes, and we head lower, and I think that's an issue. Obviously, you've got the US dollar side to think about, but I think from an interest rate perspective, if you're trying to play pure Aussie rates, you obviously stick to Aussie Kiwi, but there is also quite a strong correlation, not just in Chinese markets and dollar CNH with the Aussie, but have a look at difference between 5-year rates and 5-year treasuries in Australia and US. There's quite a strong correlation there as well. Actually, Blake, do you know what? Let's before we go to play of the day, I've got a question from Chinny. I thought I'd just address it. Producer, have you got a sterling Aussie chart by any chance? Let's see if we can hear. Oh, look at that magic!
Oh, look at that!
Hey presto! Chinny wrote to me actually earlier on Twitter, so I thought it'd be a good idea to just address that. And he or she, I'm not sure of the gender, but sterling Aussie, yeah, you can see it there. It's making an appearance on the trade-off. Great that you've reached out. Thank you very much. Any viewer questions are always welcomed. Anyway, so I've got this setup, which the producer kindly had to hand. And you can see that big resistance level at 192, around that kind of just that highs levels there as well. If I look at sterling rates at the moment, lots being priced out for over the next 12 months. A lot of aggressive hikes, and next week we got the employment data and the wages data in the UK. Of course, that was a big one where wage data last month was so hot that it really set off that 50 basis point hike. We've got a 50 basis point hike for the next meeting from the Bank of England. At the same time, there's clear vulnerabilities in the Aussie, given what we're seeing in rates being fully priced in Australia. We're getting to the end now, in my opinion, and also obviously China and obviously the proxies around that as well. The CNH has been coming off quite sharply again. How do you trade this one quickly, Blake?
Well, you know how I feel about the Aussie, so I don't think I need to say anything else.
So we go to those highs. Do we break the highs?
Yeah, I think that's the risk right now. And I know a lot of people are not so bullish the sterling right now, but if you look at the sterling dollar, the pound dollar, I mean, we're well above 126, the big breakout point. So, pound Aussie seems natural, like a breakout, and that we are going to eventually break out higher. Also, one of the other things that you need to keep in mind is if stocks do get repriced a little lower from here because of what's happening in yields and everything else we've been talking about, one of the bigger proxies would be bullish, pound Aussie Canadian or pound Aussie cross would be a likely long candidate in that situation too.
Well, I think so. The big one for me now is the offshore yuan, the CNH. The PBOC have been pushing back on yuan weakness recently, and they've not done a particularly great job so far, but they want to curb that. If we were to see a big rally coming through in the Chinese yuan, which is a massive if, of course, but we've got the Politburo meeting coming up later this month, and maybe there's going to be a rally into that situation. If we were to see the Chinese yuan rally, that would be your saviour for the Aussie dollar, and you'd see the Aussie strengthen. So you've got to keep an eye on that. Until this time right now, whilst the market's still very happy to sell yuan because it's funding currency at the end of the day, I think there's upside risks at the moment. The pound, I'll just quickly take it, and we'll go into the play of the day. The pound is an interesting one because at the moment it's been a high interest rate carry currency. But is this now going to morph into one which is a cyclical sort of growth currency, and there's growth risk to the UK? We haven't got to that point yet, but a lot of people are betting that at some stage we're going to see massive downside risk to UK growth because of this higher for longer, and that's where the pound vulnerability is. That's where the pound bears really get their teeth. For now, I think we've got upside in this pair, so we'll see what happens there. Anyway, thanks for the question, Chinny. Appreciate that one. Let's go to play of the day. I'm going to start with EURMX. Why do I like EURMX from the short side? Well, I mean, it's breaking down. Look, it's oversold. The carry trade is overloved. There's no doubt about that. Obviously, the idea of dancing in the disco and when a fire breaks out, you want to be closest to the exit point is true in carry. I think a lot of that is down to the Bank of Japan. If the Bank of Japan come out and surprise and tweak YCC, that could cause ripples in JGBs, which would spill over, and higher vol in bond markets would spill out into an unwind of the carry trade. But the carry trade is everything at the moment. Now, I will say that the Mexican, if you're looking at MEX, they've got an inflation number that comes out, I think, tomorrow. And we are expecting both core and nominal headline CPI to come down a little bit from that point. And there's a lot of people betting that we're going to start seeing the Banxico looking to cut interest rates in December. So if we do see headline inflation below 5% there, I think that could accelerate the need for them to perhaps cut a little bit earlier, perhaps November, and that could weigh on the MEX. But for now, I mean, this is down. Everyone's in carry. I've got momentum. For now, I think everyone's got a love affair of the Mexican peso because it is the best volatility adjusted carry position, vol to carry ratio on the planet. So I like selling EURMXN and continue to ride this one lower.
Nice. And Citi just did a piece on pesos earlier today too. So there you got a lot of support from the whole institutional side of the community as well.
Are they bullish? Are they bullish pesos?
They're bullish pesos. Yes, they are. So they mark up the same thing.
Well, the interesting one, Blake, of course, is that a lot of these LATAM EM currencies. I know Mexican pesos is in a different slightly league from from Chile and other places like that. But they started raising rates significantly before the DM central banks, and they look like they're about to start cutting rates. So this is they're the canary in the coal mine. They're leading us down, and I think Mexico is expected to cut back end of this year. Brazil probably at some stage soon. So we are watching the LATAM central banks who started hiking significantly before the Fed and other central banks, and now they're starting to cut. Well, I think this is maybe a blueprint for how DM central banks may be faring in 2024.
You know what? I think you just like saying chili. All right, let me turn your attention to my play of the day. God, got lost there. Is the USD Russell 2000, and this is going to be preying on the week. And I know some of you might be praying for the week, but no, in this case, we're going to be preying on the week. This is the week index. If you look at all the indexes out there in the U.S. markets, the Russell 2000 is definitely the underperformer, and this is the one that I think you have to be watching, especially if we pick up some downside momentum. There's clearly, right above 1900, you have that double top that's setting up. I think the risk is that you slide back towards that confluence, the 50-day and the 200-day moving average. You can see they're coming together right around 1814, 1815, somewhere around there. That is going to be a really big level of support on the way back down, because actually if you break the 200-day moving average, that would set up the actual double top extension that would take us towards 1700. Those are all, I'm thinking, way far ahead. But if you guys are going to be focused on shorting equities because you think that the bond market's going to have an effect, or you think, whatever your thoughts are, and you want to be bearish risk, prey on the weak, not on the strong. So the Russell 2000 is it.
Keep it simple. Keep it simple. Sell the weakest, buy the strongest. You do pretty well if that's your mantra. And I agree. I think if you want to, we looked at the Nasdaq charts and bits and pieces, but if we're going to see an economic slowdown, it's the mega cap tech stocks that trade like a they trade as a kind of defensive asset. They're almost staples in some capacity there as well. So if we are going to see an economic slowdown further down the year, it's not happening at the moment. Clearly, growth is pretty good in the US. It's sort of 1.5-2%, and we were to see bonds fall at some stage. I think it's the Russell at the moment. I think that the Russell is the weak one. I think I like that chart. If you want to be short, I think that's probably the play of the day. So well done, mate. Thank you for bringing that attention. Anyway, thank you guys for sticking with us. If you're here now, smack the like button, please. We really appreciate that. And also, if you can leave a comment, we will address those and maybe even bring them into the show like we did with Chinny as well. So thank you very much, and we'll see you guys next week.